For over a century, if you thought about Wall Street, you thought about names like Goldman Sachs or Morgan Stanley. But a quiet revolution has been happening, one that wasn't fought with capital, but with code. And it's given rise to a completely new breed of titan that is totally reshaping our financial markets. So who are they? And how in the world did they conquer what's probably the most competitive arena on the planet? Well, get this. Right now, these new players control a staggering 20% of all global trading revenue. Think about that. That's one-fifth of the entire pie. We're talking about a massive shift in power that's gone from the fringes of the financial world right to its very core. And it feels like it happened overnight. So who are these firms that have pulled off this incredible feat? Let's dive in and really break down what makes them so fundamentally different from the old guard they're replacing so quickly. All right, to really understand their rise, you first have to get the fundamental conflict here. It's a classic story, the old guard of finance versus these new tech-driven powerhouses. See, on one side, you've got old Wall Street. They were built on mountains of cash, and they operate under super heavy regulation. But on the other side, you have the new titans, firms like Citadel Securities and Jane Street. Their key asset isn't money, it's code, and most importantly, speed. Because they're private firms, they have way less oversight, which lets them be incredibly nimble. And their culture? It's completely different. It's gone from the shouting of the trading pits to the quiet helm of servers, all run by PhDs and engineers who are just relentlessly optimizing algorithms. So what lit the fuse for this whole explosion? Well, you can trace it right back to the 2008 financial crisis. New rules like the Volcker rule basically put handcuffs on the big banks. It severely limited their ability to make risky trades with their own cash. And at that exact same moment, the markets went fully electronic. This created a huge power vacuum, and these tech-first firms, who weren't burdened by all those banking rules, just stormed right in. They poured billions into tech and talent, and they could simply move faster and grab that opportunity. But it wasn't just about being in the right place at the right time. Oh no. They had a secret weapon, one that fundamentally rewrote the rules of the entire trading game. To really wrap your head around the sheer power of this approach, you just have to look at the legendary Medallion Fund. As one of the pioneers in this kind of quantitative trading, it posted an almost unbelievable average annual return of nearly 40% for over 3 decades. Their whole strategy wasn't about understanding why markets move, but just identifying patterns in the data, finding these little signals in the noise that are completely invisible to a human being. So how does this actually work day to day? Well, first, the algorithms drink from a fire hose of data. We're talking market prices, news feeds, even social media sentiment, all in real time. Second, they use machine learning to find these really subtle patterns a person could never, ever spot. Third, based on those patterns, they predict tiny short-term price movements and price assets. And finally, they automatically execute thousands of trades in fractions of a second to cash in on those predictions. What this all really means is that trading has just completely transformed. It's not an art form anymore, based on gut feelings and years of experience on the floor. For these firms, it is a hard science. It's a relentless competition for efficiency where winning and losing is measured in nanoseconds, and it's all decided by math. But, when we say AI in trading, what are we actually talking about? It's not some singular, all-powerful brain. It's really more like a whole spectrum of tools that are all working together. This chart here really helps break it down. Take a look at the bottom axis. As the task gets more complex, the AI needs to get more advanced. On the simpler end, you've got AI acting as a system input. Think of that like a smarter model that's feeding data into a bigger system, maybe an AI support tool for a human. But as you move over to the right, you get to system logic, and that's automated execution. That's the trading bot that's operating with its own set of rules. The more complex the strategy, the more sophisticated the AI has to be. And this is an absolutely vital point to get. Despite all the sci-fi headlines, these AI systems are not fully autonomous. We're not talking about Skynet here. They are incredibly powerful tools, yes, but they're embedded within larger trading systems. They operate with guardrails, like price limits, and they are ultimately subject to human supervision and intervention. The machines are not in complete control, not yet anyway. But this new world isn't without its own unique and really complex risks. When you code the entire market for speed and efficiency, you also create new invisible vulnerabilities, which call them ghosts in the machine. One of the most fascinating and maybe a little bit unnerving risks is something called algorithmic collusion. This is a potential future where independent self-learning algorithms, all just trying to maximize profit, could actually learn to interact with each other in a way that mimics illegal collusion, like price fixing. And the crazy part is, no humans ever planned it or intended for it to happen. The machines just learn it. And this is where that risk of collusion becomes very, very real. In some markets, a tiny number of firms hold almost all the cards. I mean, look at this chart. On an exchange like Euronext Amsterdam, just 4 firms are responsible for 2/3 of all trading orders. When a handful of firms' algorithms control that much of the market, the potential for them all to start acting like a herd just skyrockets. This whole situation creates a brand new class of systemic risks. We've seen flash crashes, where all the algorithms moving in sync cause these sudden, breathtaking price swings. There's the growing problem of opacity from these black box models, where sometimes even the creators don't fully understand why their AI made a certain decision. There's the danger that an AI could just learn manipulative strategies all on its own. And with so much activity in so few hands, the failure of just one of these giants could threaten the stability of the entire system. And all of this brings up a critical question, one that really cuts to the heart of law, ethics, and technology in this whole new financial era. I mean, really think about it. If a self-learning algorithm causes a flash crash or starts doing something illegal, who goes to jail? Who pays the fine? Can you actually blame the machine? Well, the expert consensus on this is crystal clear. According to the Financial Market Standards Board, you absolutely cannot outsource accountability to a machine. No matter how complex or autonomous the system is, responsibility for what it does, that has to always rest with people. So the takeaway is pretty simple. There has to be a clear line of ownership. Someone has to own the code, and someone has to own the business strategy. You can't just unleash an algorithm and cross your fingers. At the end of the day, the buck has to stop somewhere, and it must always stop with a human. And this question of accountability is only going to get more and more urgent. Why? Because this trend is not slowing down. In fact, analysts are projecting that by the end of the decade, these firms will control not 20, but a full 30% of all global trading revenue. Which leaves us with a final and pretty unavoidable question. Look, the rise of these new titans has brought incredible efficiency to our markets, no doubt. But as a handful of firms with these opaque, ultra-fast algorithms get more and more powerful, we have to ask ourselves, are we building a market that is truly fairer and more efficient for everybody? Or are we building one that's simply coded for control?